Well, excellent. Welcome everyone to our an early client event here in 2021. Had some surprises over the holiday season, including Congress passing Relief 2.0. So this is a exciting conversation. Some really big Christmas presents that came in this act, and so we're looking forward to discussing these with you today. And this, I think, might end up being our last installment in Relief Consulting. What matters most matters more. Obviously, we've got a great framework here to work on, but we'll see what transpires over the months ahead. But we do need to go ahead and get moving. I'm welcome to my friends and obviously our senior consultant Larry Triple P Clume, who's been carrying so much of the ball with us over the course of this last year. What a blessing he's been to the firm, and Paul Anglin, a partner at the firm and tax director, and of course Karen, who serves as our office managing director in Goodlettsville, in addition to being an amazing audit partner. It's spent a lot of time in the governmental and nonprofit space specifically. And I'm CJ Blankenship. So welcome. And Ben Smith, partner with the firm's running the slide right now deck for us. So Ben, why don't you tell you what, I'm going to say a quick blessing and then we'll get moving. Lord, thank you so much for this day, this time together. Pray that you just help us communicate clearly and succinctly. Help our minds to be open, Lord, and receptive to information contained herein, to be good stewards of what you have trusted us with. And Lord, we just pray specifically as we head into this year, 2021, what a year is behind us. And we come with expectation and hope for good things to transpire this year, while also recognizing that there are many that need you now more than ever. We pray that you comfort and lift up and encourage, and Lord, that you would just even heal this nation and this country and this world, Lord, from so many ailments, particularly this pandemic. In your name we pray. Amen. All right. Well, Ben, take us forward, sir. This has been our sort of calling verse and a rallying call over the course of the last year. And what a blessing to, I really thought we might need to change this coming into 2021, just to feel where we are as a nation, and really even especially Middle Tennessee particularly. But we're going to hold true to this and continue to take precaution. And I think almost as much as this one is precautionary, I feel like a lot of what we're talking about today is really opportunistic, and this is a great opportunity that's laced into many of the provisions in this act. So Circular 230 requires that we disclose not to rely on anything we talk about or put in these slide decks as specific tax advice. Please have a conversation with your CPA, and we will convert it to such at that time. So meeting logistics today, we have the same format. If you've been on some of these over the course of the last year or 9 months, really, I guess at this point, chat rules, please don't answer chat questions if you don't work at the firm, if you don't mind. And just even if you do know the answer, let us kind of drive that way. If somebody is getting some, even though we just had our Circular 230 disclosure, if you're getting an answer in there, which we will try and do, you know it's coming from a team member here at Blankenship. And hopefully Chris Griffin, Ben Smith, if you guys don't mind, really kind of help keep that chat moving, and even say something now and have it pop up so folks can see it. On our website, we have a whole archive here under news and Zoom client event of a great background of, I mean, just our team did such a phenomenal job responding through the course of this pandemic. If you haven't perused those, please do. They're very easy to understand and some great resources. Also, if you need any of the reference materials, just email us at info@bcps. We'll be happy to send those, or the Relief Consulting Toolkit, which has been just an amazing tool for so many folks. I actually found myself referring back to that last week as I was talking with a client about something that we're going to visit a little bit on today. So with that, what are we doing today? we are going to review what I've referred to as Relief 2.0. It's the Coronavirus Response and Relief Supplemental Appropriations Act, which was added to the normal annual spending bill right before Christmas. And it kind of sat around a little bit. I think it had to be flown to a golf course, but eventually on a Sunday evening around 8 or so, the 27th, it was signed and became law. So we had already put together a great, right Christmas Eve, I guess, the day before Christmas Eve, we'd put together a summary, but kind of watching and wanted to wait and shoot things out. So if you didn't get that email at 5:45 the morning of Monday, a week ago and a day ago, please go back and check, find it in spam from Constant Contact. Just some write-ups and refers back to the website. So we're going to highlight these laws, and as usual, come and provide some perspectives and conclusions. All throughout here, you're going to see some of these blueprints. We'll talk about those in a moment, but they really serve as just a foundation for our discussion. This is a building exercise on what we have spent the last 9 months of our lives processing and working with our wonderful clients, with you guys. Thank you so much. And but we are not going to have time to be able to dig back into some of those foundational principles. So as we see these, you'll see a foundation stamp, and we're just going to zoom right past that. And so perspective on this. 9 months later, I love, we're accountants, right? We love numbers, and I love how numbers work together. But it's crazy. I was looking back. March 27th was when the last bill was signed. December 27th, 9 months to the day. And there was a lot going on in the course of those 9 months. We've all lived through it, but we got it. And my goodness, this is a big one. And so as we go through today, this is our master blueprint. We're going to actually, if you look across the bottom of that, we're going to talk about almost all of these things in a very rapid fire sort of way. And so it is, there's a lot of information, and then in each one of these, I'm going to try and bring us back a little bit to the blueprints. And so what you'll see on this next slide, look for this foundation stamp as we work through. And as the foundation stamp shows up, you realize we're just going to fly right by it. But there is in-depth analysis of each one of these blueprints, not only in the Relief Consulting Toolkit, which we'll be happy to give, but also in those videos on the website. And so when you see that stamp, just think, hey, if I don't remember that, then you can go back and look at it. Obviously, always call your CPA, and we'll give you the 3 or 4 or 5 minutes summary of it, as well as specific application to you, because it is a little bit different for everybody, generally speaking. And so with that, you guys have seen this seatbelt once or twice before, so we're gonna buckle up and run through this. And so with that, Larry and I will probably tag team a lot of this, and then of course Karen is gonna summarize, and Paul's gonna hop in here on 1 or 2 things. So Larry, my friend, are you out there?
I'm with you, CJ.
Yes, you are.
Good morning.
Good morning. Welcome, Larry.
Great to be here, CJ. Boy, what an amazing benefit for so many of our small business clients that this bill has in it. Not the least of which is the expenses that you paid with your forgiven PPP loan are now deductible. This was somewhat of a surprise for us last spring that the IRS made this ruling, but Congress came back and clarified that no, if you paid wages, other qualifying expenses with your PPP funds, those will be deductible. And they also made I guess, technical correction, or that you will be allowed, if you're a partnership or an S corporation, to increase the basis of your ownership interest for the forgiven loan amount. So this is all great news.
This was amazing. I mean, and a little bit of a Christmas surprise, maybe a Christmas miracle even, because there had been so much conversation and guidance around this from Treasury Secretary Mnuchin. And it was pretty, standard as we were doing our end of year projections for all of our clients. Obviously, this is what we were dealing with, is this, significant tax hit, which was logical. The logic behind it made sense, but nonetheless, now we get to really have our cake and eat it too, to be able to not only receive the tax-free income, and receive basis for it, which is very important, so that we can deduct those expenses, and then also deduct the expenses. I mean, this is huge for our clients, very significant. Thank you, Larry. So let's move to the next one, Ben. And we can't probably stress that enough. That is the biggest thing. I'm sorry, Larry, I just maybe pause for another 30 seconds on this. I mean, I'm not sure if this is really sunk in with everyone. But I mean, if you had $1 million triple P loan, you just received somewhere in the vicinity between, 350 and $450,000, depending on what state you're in. I mean, it's huge, isn't it?
Well, it's absolutely huge because your effective state and local tax rate times the amount of your PPP loan. And, for many of our clients, we're talking 35 to 40% effective tax rate. So as you point out, CJ, on $1 million loan, this could be $350,000, $400,000 of extra benefit for that borrower. So it's absolutely huge.
Yeah, it is amazing and a very pleasant surprise. So, well, great. So Ben, let's move to the next one. So, the this right here is just kind of a outline of everything around the original eligibility of the Triple P program, the Paycheck Protection Program. But we're going to get a second bite at the apple, aren't we, Larry?
We are. The new bill provides for a second draw PPP loan, which we're commonly calling the PPP2 loan. This loan is going to be available to borrowers who experienced a 25% decline in their revenue during any quarter in 2020 compared with 2019. And this covers a lot of our clients. I mean, obviously, you immediately think of our clients that are in restaurants, hotels, really hard hit businesses. But recall last March and April, where many businesses were subject to the stay-at-home order and could not be opened. So you think of dentists, ophthalmologists, veterinarians, other types of businesses that had to be closed. Many of our clients experienced a 25% decline in revenue in the second quarter of 2020. You'll be eligible to get another PPP loan. For most borrowers, it's going to be typically the same amount as last year's loan, last April's loan. However, if you are in the hospitality or food service industry, your loan is going to be based on 3.5 times your average monthly payroll cost, whereas the original loan was based upon a 2.5 times. So you'll be able to get an even larger loan subject to an overall $2 million cap.
It's amazing. That is a real boom. This Paycheck Protection Program loan, and we're going to talk about something else here in a moment that was really great during the pandemic. But this has been hailed as one of the great. I mean, this was an amazing program that came out by Congress, and now the first batch, pretty much everybody got it as long as you could meet the uncertainty representation, which became an automatic for anyone less than $2 million in triple P loan amount. So this has been a big lift for the small business industry, which is really where this came into effect. Granted, there's some negative media around it, but what we've seen with our client base is this functioned well. This worked.
I got it.
And
Oh, his card. Okay.
hey, Ben, why don't you
Yeah,
mute
I'll
all
talk
real
to him
quick, and
about
then
it.
we'll
Sure.
unmute ourselves. Great. Sorry about that. Hey, Larry, welcome. But I mean, this worked.
It was really effective at getting money out quickly to needed, for small businesses. And that's something the government historically has not been able to do. But this program worked to get money out in a matter of weeks. So it was really very effective. And you may recall that, the money back in April, the initial funding for PPP was exhausted within 2 weeks, but Congress came back in June and reauthorized additional funding, which allowed PPP loans to go through August 8th. And actually that second round of funding was not completely used up.
That's correct. And so hopefully there will be more than enough this time around. But I think given the experience of last time, which is a great memory, Larry, is, Congress came back, acted quickly, authorized more funds once they were exhausted. And so hopefully we can see something similar here if it was to be utilized. But the key difference here is this revenue drop. And so to have that revenue reduction, 25%, but to your point, Larry, I was talking to a client last week that did well, had a good year overall, but my goodness, in that second quarter, stay-at-home orders, a lot of their particular customers were significantly affected as a supplier. And so, they're going to qualify and they're going to get a nice size second triple P loan. And so, given all the parameters around it, tax-free income, still get the expenses. I mean, this is huge. So really exciting.
Yeah, it's such a huge benefit. Certainly, it's worth your while to go back and review those quarterly revenue amounts to make sure you do or do not qualify.
That's exactly right. Go back, study, do the math right now, and you might be pleasantly surprised, like our client was last week. I didn't think they were going to get there, but we made it by a couple percentage points. Really exciting. So, in a big loan. Well, great. So Ben, let's advance the slide here. So we're getting to one of my kind of favorite little sleepers in the, this was before the CARES Act was passed. We had the FFCRA, and so this is our blueprint. There's actually a series of about 6 blueprints that are required to kind of go through how all this works. But more or less, and Ben, if you'll go to the next slide, well, there's really 2 big things that came in this act. Well, there's a lot, but 2 that we've really been focused on. And the EPSLA, the Emergency Paid Sick Leave Act, and the EFMLEA, the Emergency Family Medical Leave Expansion Act. And so the new bill extended these for another quarter through March 31st of 2021. And these have been really heralded as a great tool that was out there, and that a lot of folks still have not really understood or taken full advantage of, where basically you're allowed to have 10 days of paid sick leave. That's the first one, or to elect 30 up to 10 weeks of paid leave to take care of family. So
all the way.
hey Ben, do you mind muting all again real quick? Excellent. And so these have been some wonderful tools that have been out there to allow us to be able to come alongside when our employees are getting sick and they're not feeling well, or they're needing to take care of their family at home, to where there is a fully, if you are eligible, you receive a credit back for every single one of those dollar wages, as well as not being subject to Social Security, and you even get a benefit for the medical insurance that's associated with that. And so this is, we've got a picture of our friend Don King down here. If anybody remembers, from the 80s and still doing it today. He's a great promoter. And so, we have the post and promote strategy we've been talking about. And so, if you are eligible for this and you haven't taken advantage of it yet, whether it's those 10 days of full pay if they're actually sick, 2/3 pay if they are taking care of somebody else who is sick, and there is a max 511 per day or 200 per day in the lesser amount. But get this out there. Talk to your employees about it. This has really worked well to help slow the spread. And so what I would just encourage you to do, and it's a windfall for everyone. It doesn't take anything from you. And incrementally, we're going to take care of our employees anyway. And so really what this ends up being, if you're eligible for the credit, is a dollar for dollar benefit to the bottom line, less some, obviously less the normal credit versus expense integrations for tax law. So, was extended. Very excited about this extension. Make sure you take advantage of this. So just to clarify, EPSLA is 10 days and EFMLEA is up to 10 weeks after taking 2 weeks unpaid, which you can load up on the front end with the EPSLA. So this is a really big deal. It's in our blueprint. We've got a lot of information out there. There's a great write-up on the website that covers all this in detail. And so please take a look at this, talk to your CPA about it. Your payroll provider should know about it, although every once in a while I'm a little surprised. So, but this is huge. Post, promote, make sure employees are taking advantage of this, especially over the last quarter here. All right. So now this is a big one. And I don't think I realized how big this one was really until the last 24 hours as we started kind of digesting this a little bit more. And so, Paul is going to join me as we talk about this. The ERC, if you're cool, the Employee Retention Credit, is a credit that came out that allowed, and originally, you'll remember from our previous presentations, that this was a consolation prize, is the way that we referred to this. So if you received a PPP loan, then you were not eligible for the Employee Retention Credit until now. And so why don't we advance the slide forward here a little bit, and we're not going to go back into all the eligibility and all the different pieces of when it applies and how to calculate, et cetera, other than just big picture. And it used to, if you had a revenue drop, and in the past it was 50%, then in a quarter of this year versus last year, and then there's a bunch of other rules for if you were in business, if not, et cetera, then you were eligible if you did not receive a triple P loan, and that's key, not forgiven, just did not receive one, then you could take advantage of the employee retention credit, which allows you to have a credit of 50% of up to $10,000 in wages per employee. Now, this credit specifically was going to be limited to that 10,000 total. It was calculated on a quarter by quarter basis as far as eligibility was concerned. So once somebody went through 10,000 in wages, that was it for that employee. And so two huge things transpired in this act. First of all, it's not a consolation prize anymore. Now you are eligible to take the credit in 2020. This is retroactive back to when the bill was originally passed, even if you received the triple P loan. And so, Paul, are you out there, sir?
I am, CJ.
Wow, this was a big deal, wasn't it?
Absolutely. I know you've stressed it a couple of times, but I'm going to say it just one more time. I think back when the CARES Act was passed and we were doing some of our summer sessions, I think we were so involved in the triple P loan when we got to the slide about the employee retention credit, everyone just kind of glazed over because we started the whole presentation with, if you got a triple P loan, this doesn't apply. And I believe probably over 95%, maybe even higher of our clients went the triple P loan. So this was really irrelevant for most of our clients. So what a Christmas present, something retroactive back all the way to March to be able to claim the employee retention credit. So now we can double up potentially on some benefits, and I'll use that term carefully there. We can double up on the benefits of PPP loan and employee retention credit, but we can't use the same wages and get a double benefit. So like many of the things that we've seen with the other credits from the Family Leave Act and other things, you can't double dip. So that is something to keep in mind. But there's definitely some planning opportunity around here. Wouldn't you say, CJ, if you think about the period of wages back in March and April, that's probably when a lot of our clients did experience that 50% decline in revenue. Then they come out and say, well, now you have 24 weeks to incur wages on your triple P loan. So maybe if you haven't already applied for your loan forgiveness application, maybe there's a way to look at that a little bit to say, can we pick and choose what wages we're going to use and then have wages available in the period that would allow us to have the employee retention credit. So may not apply for everyone, but definitely an opportunity.
Oh, it's huge. The historical perspective on this is that, that 50% revenue drop quarter over quarter is a pretty big number, depending on the company and depending on whether you had a closure or not. But to your point, Paul, if you have this, and so I think this is kind of, as we're talking about the historical, we'll pause for a moment on this and say, if you had a quarter in 2020, specifically that second quarter is really where the money is. And we're going to talk about why here in a second. But if you had a 50% revenue drop, you obviously probably got a triple P loan. But historically, this was off the table. Now it's back on the table. And so it's really important, though, since you can't double dip, you can't use the triple P forgiveness dollars and then turn around and also use those to satisfy expenditures for forgiveness, and then use them also to get the employee retention credit. But what you can do is push off the utilization of those dollars into a later period. And don't use those dollars for the triple P forgiveness. Instead, use the triple P forgiveness dollars in the later portion of the 24-week covered period. And maybe in that second quarter of 2020, when you had that 50% revenue drop, use that for the employee retention credit. And now you kind of get two stabs at that, which is really, it's really significant. So important to integrate that planning in with the triple P loan forgiveness application. I have not seen any ability to amend if we have some of these filed. Most clients at this point have not filed. We have filed some. And so again, this only really applies for 2020 if you had that 50% quarter over quarter revenue drop. And so that is really important, but a huge opportunity. Now, where it becomes even more special, especially for our triple P2 recipients, my goodness, 2021, this thing got juiced up really, really nicely. And so now as we look to 2021, this expired, at the end of the year, but it has been extended under the new act to cover the next 2 quarters. So this is good all the way till July 2021. And this is where it gets really good, guys. It's still a quarter by quarter basis, but now instead of 50%, of 10,000 max, it's 70% of 10,000 per quarter. So there's another $14,000 out there that can get layered on top of this if you meet the requirements. And again, we'll have the same integration with the triple P2 rules. So we'll have to decide, okay, if I'm eligible, most likely, if you're going to be eligible for this, you're probably eligible for triple P2. So there's going to be this little kind of play of integrating all these pieces together in order to be able to get the maximum benefit, not only of that 2.5, or for many of our restaurant and hospitality businesses, we're talking about 3.5 times in triple P2 of that average monthly loan amount, or monthly loan amount, or employee compensation for 2019. And so it's really a big deal. And integrating these pieces together becomes very important. And so this is not something to be taken lightly. We need to be careful about which wages we use for the credit, which wages we use for the triple P forgiveness, and then pushing all that together. I mean, basically it allows us, at 2.5 times, you had the old 15,000 and some change number. Now you get to pop an extra 14 on top of it. Plus you had the 15 from last year. And so all of a sudden you end up in a spot where you've got, $45,000 almost of potential benefit out there if you can play this ball right, per employee, depending on all the different math that comes in. So, I mean, it's a big deal. It's a big deal.
Well, CJ, this is Larry. The other thing you want to keep in mind is qualified forgivable expenses include non-payroll costs.
Right.
And the relief bill added 4 additional categories of forgivable PPP costs. So you use those before your wages.
Which is wild, because that is the exact opposite of what, before this bill came out, was the logical and most readily acceptable approach, which was to use the wages. And so to that point, Larry, absolutely use your other different qualified expenses. You still have the 60-40 rule that's out there, right, Larry, as far as spending compliance. And so we've got to make sure that 60% are wages, but let's pick and choose those wages and then use the other 40% towards the triple P forgiveness of other covered expenses. Great point, Larry. Go
Larry,
ahead,
you stole my thunder, but just to reiterate,
Sorry, Paul.
No, that's fine. But just to reiterate CJ's point, I mean, there's a lot of analysis that can go into this to figure out the maximum benefits. So, obviously, we would love for you to have a discussion with us and let us help you down that journey if that's what you so chose. But it's definitely a way to maximize, and we just need to look at it.
Absolutely. And it's a retroactive look too. So that's, I think, the big thing that comes into play here. You really want to ask yourself 2 questions. One, did I have the 50% drop during 2020 quarter over quarter? And if that's the case, all right, well, it's time to get to work. Call your CPA. We're going to get most likely Larry or Paul are going to get involved, and your CPA is going to do some analysis, and we're going to try and figure out what the best approach is in order to integrate those. And then for 2021, have I experienced a 20% decline? And so it's going to be a lot easier to get that 20% decline than the 50%. Although we have it. I mean, we have it. We've seen it. And so this is out here. It is applicable to much of our client base, particularly the restaurant industry. And so now this is a really big deal. And so looking forward to hopefully processing this with you guys. And I mean, this is I cannot stress, these are credits. These are worth a lot of money. Credits are always better than deductions. It is a dollar for dollar benefit for you. And so this is huge. It's like, hey, I'm only going to have to pay 70% of the wages for this particular employee if I can qualify for this. And so please, study it. Don't miss out on this opportunity. And then if you had the really big hit last year on a revenue perspective, we got to go back and do some work for 2020, right, Paul?
Right, CJ. Absolutely. We need to look at that.
All right. Well, great. I, spent a little extra time on this one, guys, but this is kind of a sleeper in this act. And I mean, I have to be, fully transparent around it. I was, this is in section 206 and 207 of the new act, and I was flying through there, and the way it's worded, you don't pick up on it because it just literally has one little line, like 8 words. We're going to strike section J of the CARES Act in this particular, section. Now it's just like, okay, moving on. 70%. Wow, this is great. It's like, wait a second. We back study. It's like, oh my goodness, this isn't a consolation prize anymore. This changes everything. And so it does really, really a big deal. So, I want to stress this. I want you to hear it loud and clear. If you have the 50%, drop in 2020. You have the 20% drop in 2021. This is a great benefit that we need to integrate with the triple P1 or triple P2 and hold off on that forgiveness application, particularly for 2020, if that is the case. So, all right. Wonderful. Well, Larry, I think that this one is you, but this was a neat little, back in we called it Pamplona for the bankers in the insanity of triple P1 and the run on the banks. And we ran out of money. Who knew Congress was going to come along and add some more funds? That was really a great move, but it was crazy. And so early on, as this was transpiring, we saw some banks that would come back with some loan amounts that weren't right. And oftentimes our conclusion was, we talked to the client about and said, do you want to argue with it? This was in the first 7 days or so. And it was crazy. Do you want to argue with it, or do you want to take the money and run? And so Larry, tell us, how that played out and what happened here in the new act.
Yeah, you're so right, CJ. Early on, those early days in the first couple of weeks of April, the rules were not clear, and we saw banks using a wide variety of practices. And by the time we got clarity on what did qualify and how you could calculate your loan amount, many of our clients had already obtained their PPP loan, correctly so, because the money was running out. So this provision allows, if you did not get the full amount of loan you're entitled to and your loan has not yet been forgiven, the law allows you to go back to your bank and increase that loan amount. Now, let's wait and see. Administratively, I would think that this is going to be a nightmare for the banks to implement, and we'll have to see how the banks respond. I think, again, here we're going to have a wide divergence in practice amongst banks. I would think that some banks just won't do it, and others will likely set some kind of a minimum. You're going to have an increase of at least $20,000 before we'll do this for you. So keep it in mind, and then stay alert to communications from your bank as to whether or not they're going to allow this.
And for those, I think the thing we saw the most, Larry, was either one, not including the self-employment earnings. I mean, that was probably the biggest one. Would you agree?
Yeah, we saw, particularly with the partnerships we deal with, many banks were not allowing the partner's self-employment income, or if you're a sole proprietor, the income from Schedule C. A couple banks in Nashville were deducting withheld federal income and FICA taxes, which was not correct. So those were the two big ones that I saw, but all kinds of different practices.
Yeah, those were definitely the two biggest ones. And then some of the other, benefit that was eligible payroll cost might get, whether it was health insurance or retirement contributions, might have gotten stripped out occasionally. But yeah, those are the big ones. So if for some reason back at the time, you go back and look at that. If you haven't filed for forgiveness, right, Larry, go back and take a look at that and see if there might be the opportunity to get that loan amount increased for things that were left out. Most likely, if it was left out, but I mean, those were the big things, right, Larry, that I think,
right.
That, if you filled out that loan application, if in the back of your mind you say, well, I didn't get anything for myself, or I had to reduce, and that was a big one. I mean, that's a big deal. You think about 20 or 30% withholdings for some employees. That FICA tax, I mean, we saw that on multiple bank applications where they backed out the FICA tax withholdings, which is just crazy. Yeah.
So yeah, if especially if you're a partnership or self-employed, make sure that your self-employment income was included in that original application. Your retirement plan contributions, health insurance, those are some of the common things that were omitted back in the spring.
Absolutely. Thank you, Larry. Absolutely. So, all right, great. So Ben, let's move on to our next one. So the loan forgiveness process, goodness, Larry, what a journey this one has been, man. I tell you what, we have studied application after application and rule after rule and streamlined and all these, and 75, 25, 60, 40, it just in 8 weeks, 24 weeks, man, it's been a moving target, hadn't it?
It sure has. But the bill that Congress passed back in June really was a game changer, because in that bill, two major changes. One is that they extended the cover period from 8 weeks to 24 weeks. And then the requirement for payroll costs was reduced from 75% to 60%. percent. Once those two changes were made, nearly all of our clients were in a situation where they were going to get 100% forgiveness. And that's what we basically have seen as we've begun to file these applications now for forgiveness.
Absolutely. And you know, and it was really easy just to use payroll expenses, candidly, because there was really, unless you were in a situation where you had some other related grants or you had some other related credits that were out there, you know, the WOTC credit, work opportunity tax credit, things like that. It's just, there was so much at 24 weeks. The original loan was based off of 2.5 months, right? So 24 weeks is a lot more than that.
Right. That original loan was based on 11 or 12 weeks of payroll cost. And when you were allowed to use 24 weeks of what you paid in 2020, nearly everybody had, you know, well more than what they needed to get full forgiveness. So as we filed these recent applications, we're simply using wages to avoid the necessity of providing the bank with all kinds of other documentation. Now that may change, as Paul mentioned earlier. We may want to start using some of the non-payroll costs in order to maximize your employee retention credit.
Yeah, and especially for triple P2 and the new 20% reduction rule. Probably not. I mean, it's you've got to have a serious hit of 50% in the prior years to be able to, you know, take advantage of it on a historical basis. And it's not as much as well at you know, max 5,000. Still significant. You know, we don't want to laugh at $5,000 per employee, but integrating that is going to be really important. And to that point, you know, some of these other expenditures, the documentation requirements from the bank and from the SBA have been really significant, and rightfully so. You know, you're receiving this money, but in order to spend it on these specific covered expenses. And so there's been a lot of information that has to be provided in order to be able to build the forgiveness application, and then must be retained. So we do have a little bit of a streamlining of some of this for the loans for less than 150. So Ben, why don't you advance the slide here, and Larry, tell us, you know, a little bit easier. It's kind of like, hey, the tax return is an easy tax return, but you still got to keep all the stuff, and you still got to do all the work behind the scenes. But tell us, I mean, this is a big deal for the less than $150,000 loans.
Yeah, it's a significant administrative relief in terms of burden. For loans of 150,000 or less now, there's going to be a one-page application, which is basically a self-certification that you've spent the money for the proper expenditures. And then you will file that with your bank. You're not even required to submit the payroll records, other supporting documentation to your bank. SBA has not yet released the form. They have 10 days to do that, so sometime this week. But you are required to retain your payroll records for 4 years and your non-payroll records for 3 years. And so you're still subject to audit. So as a matter of prudence, I would certainly suggest that you're going to want to put together a schedule, put it in your file just to show what expenses you incurred in the 24-week covered period that gave you forgiveness. This will also be important when you go back and try to coordinate this with the employee retention credit. Which expenses did you use to get forgiveness?
That's exactly right. I mean, it's very important. You still need to obviously create the documentation and then retain the documentation through the entire period, 3/4 years. And so a little shorter than the 6 years that's out there for the over 150, but nonetheless a significant. You don't have to send all the stuff anymore, which is
Right.
kind of nice, but you still have to put it all together, especially if you're going to fall into this 50% reduction for 2020 or 20% quarterly reduction in 2021, because you don't want to double dip on this. We want to be really clear which wages we're using for what.
Right. And the other nice simplification here is that if you're going in to apply for a PPP2 loan, the same $150,000 threshold is there, and you're going to have a simplified application process if your loan is $150,000 or less.
Yeah, that's a big deal too from an application standpoint. So, but get ready. And so to that point though, Larry, and this isn't in our deck, but have you heard of any, you know, opening up of any triple P2 programs at this point? I mean, thus far, I think we're still in a holding pattern.
We're still in a holding pattern. We're waiting for the SBA to release forms, instructions, and guidance. And of course, all of the banks now have largely, if your loan is less than $150,000, my understanding is all the banks have shut down their portals to those loans. They're not accepting those applications until the SBA comes out with the guidance. So I would think sometime next week, we'll see the simplified forgiveness application, and also likely sometime next week, we'll see the forms, instructions for the new PPP2 loan applications. And then a few days after, it'll take the banks a few days after that to update their portals and get them ready to go. The good news is that a lot of the confusion that we had last April when this all had to be done from scratch, the banks should be in a much, much better position to accept these new PPP2 loan applications shortly after the SBA releases the forms.
Yeah, I think we're in a much better spot to that point, Larry. You know, the foundation has been built, much like this presentation we're working with you guys on today. And with that foundation built, they're able to kind of go ahead and, frame it up really quickly on top of that great foundation that I think has been developed over the years. And so, on the forgiveness side, as well as the new loan applications, I think it's going to be a little bit quicker. I do want to just for a brief second, and let's go talking about the forgiveness process. I want to focus for one moment on the over $2 million loans, because Larry, this isn't a huge list, but these liquidity, just to plant a seed in case folks have not heard about this, the liquidity questionnaires are out and they're being circulated, and they're pretty important, from a liquidity operations standpoint. So Larry, do you mind just doing a quick plug on that? Obviously, if you're over 2 million, you probably already know about this, but I want to just mention this because, I think all of the new loans at under 2 million, this isn't going to be as big of a deal, but maybe just do a little plug here, Larry, on the
Sure.
operations and liquidity questionnaires.
So if your original PPP loan is over $2 million, when you file for forgiveness, shortly thereafter, your bank is going to transmit to you either a form 3509 if you're a for-profit, 3510 if you're non-for-profit, and it's a 13 question questionnaire. Those questions are rather detailed. They're not yes/no questions. They require some depth. And what the SBA is really looking at here is, tell us about your organization. Tell us why you believe you had economic uncertainty back in the second quarter of 2020 that entitled you to get this loan. And it's really critical that you take some time and prepare this accurately and get correct information back to the SBA. Now, the SBA is only giving you 10 days to respond. So we're recommending to our clients that did get a loan of more than $2 million, get a copy of this form, look at the questions, prepare the responses now before your bank asks for it so that you give it some thought. Because this is all or nothing. If the SBA determines that you did not meet the economic uncertainty requirement, you're going to be required to repay in full that loan.
Yeah, we're talking about a lot of money in those circumstances. And then you layer on top the fact that you were able to get the double benefit of the tax-free income and still deduct the expenses. It just got even worse. And so that documenting that and doing a great job on these applications is really important. So please reach out to us. We've helped process these for a couple of our larger loans that are out there. And it's really important that you fill it out and answer the last questions and get a lot of supplemental information in there and use all 1,000 characters. And then I would say, attach a lot more, even though they say they don't want it. And you really want to be able to tell that story well. And in that uncertainty, and that's really what this all hinges on, this next batch here, we're all under 2 million. And so in theory, if you've had, and I think, Larry, this is the way I'm kind of reading into this. Tell me if you feel the same way. I think with this 25% revenue decline that's out there, in order to be eligible for PPP2, then it feels it feels like that's kind of the threshold. That uncertainty representation might not be quite as big of a deal this time around.
Yeah, I haven't seen that in this statute. I don't believe they're going to require the economic uncertainty representation for the PPP2 loans. They are requiring it for these Save Our Stages grant. We'll talk about that in a minute, but I haven't seen that for PPP2.
Yeah, neither have I. So it looks like if you have the revenue decline, you're gonna, it's gonna be an assumption, and it's under 2 million, and we had the under $2 million automatic assumption around uncertainty that transpired. So that seems logical. I think that's the way that's going to play out. But we'll see what the final regulations and guidance from the SBA says, right, Larry?
Right.
All right. Well, this next one, just foundationally speaking, the EIDL, the Economic Injury Disaster Loan. This is something that was out there. A lot of our clients especially went for the $10,000 grant, didn't they, Larry? And so we got some good news on that $10,000 grant. Ben, if you don't mind advancing the slide.
Yeah, a couple of pieces of nice news on the EIDL advance. For everyone, you may remember, this was the advance that was limited to $1,000 per employee, not to exceed $10,000. It was in the form of a grant. However, when SBA came out with the forgiveness, PPP forgiveness, they said, oh, we're going to reduce your forgiveness by the EIDL advance. Well, that's been done away with. So if you've got a $100,000 PPP loan and a $10,000 EIDL advance, you will now get $100,000 of PPP loan forgiven, even though you got the EIDL advance. The other nice benefit is the $10,000 EIDL advance, or whatever your amount was, is not going to be taxable. And the expenses that you paid with that advance will be deductible by you. So two nice benefits for EIDL advances.
Yeah, that was a big deal, really exciting, and just an extra little some icing on the cake there. There was kind of almost like there's been some nickel and dime perspectives that were built into the original bills, and then now as we look back on it, Congress continually is just making it easier and making it better. That has been the theme, and again, that's what we see here with the $10,000 EIDL advance.
Right now, we've already had a number of clients apply for their forgiveness. And have the forgiveness reduced by the EIDL advance they obtained. The bill requires the SBA to now go back and forgive, if you had a $10,000 advance, forgive that $10,000 of the PPP loan and remit that to the bank.
Yeah, and so that'll be, though there are either folks that still have a $10,000 loan on the books, or they went ahead and paid it off. So either one of those scenarios, either the $10,000 is SBA is going to send an extra check and it's going to go away, or the bank's going to get some extra money and they're going to, put it in your bank account for you, most likely. So
correct.
Very good. Well, let's move on here to a couple of other sort of clarification integrations. This one on the 501c6s was a pretty big deal, Larry, and both for PPP1 and PPP2.
Right. So there's an expanded opportunity to get this for 501c6 organizations, which are realty boards, chambers of commerce, and also for certain direct market or designated marketing organizations. You think about here of tourism boards, things of that nature. They're now eligible to get a PPP1 and a PPP2 loan if they meet their revenue decline requirement.
And this is, they kind of got left out of the original batches. And so it's time to go back and file for the original. And then and most of these organizations have had, particularly because a lot of these organizations have in-person activities, and that is
right.
exactly what has been prohibited during the course of this pandemic. And so most of these organizations are probably also going to meet the eligibility for PPP2. And so this is a big deal. Now, a lot of these folks were probably already taking advantage of some of the other provisions that were out there, but this is a really nice benefit. Obviously, these folks have good lobbying organizations that are oftentimes built in. That we have the limitation on the amount of lobbying activities that can transpire, but they had a good lobby. I remember hearing from the AICPA national lobby representative saying, hey, we've been working on this for the member organizations. So, yeah, you've been working on this for yourself, and of course all the member organizations as well. But it's a big deal, and it's significant. And so to allow these folks to get in here, and because a lot of these organizations have seen a drop in membership, they have seen obviously a huge drop in the whether it's in-person learning or social events, et cetera, that are a big foundational framework for 501c6s. Now, this next one is exciting. I love this one, Larry. So tell us about this new grant for shuttered venue operations.
Yeah, this was really interesting. This was an initiative that was largely led by some of the Congress people from New York and California, but particularly New York. You think of the Broadway theaters and the impact that COVID has had on them. But guess what? We're in the Music City. So I would imagine that many of these provisions will apply to some of our clients. So what this does is, if you operate a performance venue, or are a performance operator, or a talent manager, if you meet certain conditions, you'll be permitted to file for this shuttered venue grant. The grant is 45% of your 2019 revenue, limited to $10 million. So it's a very significant grant if you are eligible. And to be eligible, not only do you need to meet the definition of one of these types of organizations, you also have to have a 25% decline in revenue. The few clients that I've talked to already, that part of it is not a problem. There's also going to be a 3-stage application process. So you'll get preferential treatment in phase 1 if you've had a 90% decline in revenue, There'll be which is a 14-day period, and then another 14-day period for those that have had a 70% decline, and then everybody else. But if you are in the entertainment business, operate a venue, movie theater, museum, think about the Grand Ole Opry Museum. Think about this, take a look at this, and see if you qualify. Now, one thing to keep in mind is you can get this or you can get PPP2, but you cannot get both. So generally, this is a better grant than PPP2, but you have to look at your specific back situation.
That's right. I mean, this 45% of the 2019 revenue is a big number. Now capped at 10 million, obviously, but most of the organizations that are in this space don't have that much payroll just by virtue of how they function and are structured. Museums a little bit more, but performing arts, a lot of times it's minimal. And so that 45% of revenue is a big deal. And so don't just jump on the triple P2 bandwagon. I think that is the main thing. It's like pause. And if you can qualify for this, generally speaking, just do the math. But I'm not really sure how, unless, of course, 2019 was just a weird year, that you're not going to have a better outcome with this particular grant.
Absolutely. You think about, we deal with a few talent representatives where they book, particularly music acts, and they've had a terrible 2020. They fall into this, the availability of this grant, and you really need to take a look at this because this could be a very significant replacement of your income.
Absolutely. Yeah, it is significant. This was one of the most, I felt like, just other than the employee retention credit and its integration, obviously Triple P2 loan's really good, but this one was just a really special thing for the folks that I think, restaurants have been hurting. They get the extra 3.5 instead of 2.5 on the Triple P2 round. That's great. But for, we work with a lot of music business and a lot of nonprofits, whether it's ballets or museums, and they've really been hurt through this process. And so this grant, I think, is really, really nice. And, that preferential treatment, the tiering with the 90 and the 70, we'll see, and how much the money goes. But get in line, I think, is the important concept here. Would you agree, Larry, Paul?
I absolutely agree. And again, keep in mind, SBA has not released guidance on this yet. It's a different subdivision of SBA, but I encourage you, do the homework now. Look at those revenue declines, see whether or not you've got the 25%, and then also see whether or not you can get into one of those first groups to apply, because you want to be in there first if in fact the money might run out.
Absolutely. Absolutely. Big deal. Really big deal. So we've got 2 tax points here, Paul. This first one's kind of easy. It's nice. We back in 2017 with the Tax Cuts and Jobs Act, one of the things we talk about is they popped the party balloon, took away our deduction for entertainment expenses. It used to be 50%. Now it's 0. And they didn't bring back the party. Of course not, right? Although this would have been a year to bring back a party, but they did allow us to get some extra benefit on the meals.
Absolutely. Yeah, something's better than nothing. We'll take it, right? So
right.
Again, not retrospective, but just for 21 and 22 years, 50% of the, 100% deduction for the meals instead of the 50%. So that's very nice. Just keep in mind, it's still for qualified business meals, and all the other documentation and everything that goes along with that still applies, but the 100% deduction, so instead of 50% limitations, that's very nice.
It's nice. The only thing that would have made it a little bit more party-like was if we got back our entertainment expenses. I still can't believe those are gone. We need to figure out how to get those back on the books. So maybe in Relief 3.0, right?
There's always hope.
Yeah.
Absolutely.
And I guess depending on what happens with the election in Georgia today, that we're not going to go there. But if it depends on what happens there, we might have another busy year ahead in the accounting profession. So we're hoping for not a bunch of new tax bills, but that this is a Tax Cuts and Jobs Act specific piece. So that the platform is to repeal that. So we'll see what happens. All right. With that, we've got a list. We're not going to spend much time on this, but they also roped in the typical extenders package, right, Paul?
Right. And I'll hit just a couple here that are probably important. I know in your opening remarks and prayer, CJ, you talked about the people suffering from the COVID. And one of the nice things that if you have had medical expenses, they've reduced the floor from 10% to 7.5% of your adjusted gross income. So hopefully that can benefit some people this year that had obviously impacted from that. And then just the usual litany of extenders, as you mentioned, the work opportunity credit, new markets credit. There's just always credits that have a 1-year time life on them, and then Congress come back and extend those, which was kind of curious here that not just the typical 1 or 2 years, and there's no consistency of the extenders. There's 1 year, 2 year, and 5 year extensions on a lot of these provisions. So what we know is they are eligible now, but you might want to check just to see how long those run if any of these particularly apply to your situation.
Absolutely. I think my favorite one that was in there, I don't know if we had on the slide, but I think there was some deep mine rescue operations or something like that credit. I saw that was extended. That's really exciting.
Yes, I got really excited about that one. Yes.
Yeah. File that one on, at least 50% of the tax returns that we do.
Absolutely.
Each year. So, well, with that, Paul, thank you so much for your great leadership in our tax department. We're going to switch gears a little bit here to the governmental and nonprofit relief that's available. Karen, are you out there?
Hear me?
We can hear you.
Sorry, coming to you from one of our conference rooms, so the audio is a little bit different today.
That's great, Karen. Thank you. We can hear you loud and clear. And we've got the governmental nonprofit relief slide up here and your area of expertise, to say the least. And you've combed through the bill. Thank you. Welcome back from vacation, right? Hey, Karen, can you read this bill for us and give us your insight? But we are happy to hear about it. So, Karen, share with us what all's in there.
6,000 pages in 5 minutes. So is more of the same. So at its core, this bill was an appropriations bill, which always benefits governments and not-for-profits. I mean, that is the definition. So just some key provisions in there: expansion of some of the Social Security programs, 400 million additional for existing programs, Safe Families, a lot in there for foster programs. Interesting provisions: it increases the child age definition for some of these programs to 27. So some of those programs where childs would have aged out, it waives exclusions and limits and increases that amount to 27 for this year. And then eliminates certain state matching requirements, which is really relevant if we've got any of our governments that are or not-for-profits that are participating in these programs and administering some of these programs, because the state matching has been waived. So that could be significant. Also extended, I don't think this has been mentioned yet, but extension of the emergency unemployment, a lot of press about this one. So that's been extended to March 14th, 300 additional. It was opt-in by the states, and Tennessee is an opt-in on that. And then you mentioned already the venue relief, but I just wanted to include, that does include venues that are operated by governments and not-for-profits. So events, free venues, and then there are some provisions on if it's for educational purposes and that type thing, that those relief options are there for them. And then the last bullet there is just improvement and expansion of STEM. So for those in the governmental or in the not-for-profit or educational space related to science and technology, some new options, and this one interestingly comes through the CIA budget. So I just mentioned that because that was fascinating to me, that we got some expansion of some of those programs coming through a new agency. So I think that's it. I'll toss it back.
That is really interesting, through the CIA. I heard that the CPA profession is trying to get accounting loaded into STEM, so it would be more like STEAM at that point. So definitely not as sleek as the CIA, but we're trying to get in there too. So, but thank you, Karen, for a great summary. And it is, I mean, that is, I think, as you mentioned, Karen, at the core, this is an appropriations bill. And there was a lot of drama around this bill, let's say, around where money was being spent in foreign countries, et cetera. The reality is, this is our normal annual budget. There is a lot of money that is being spent, and we just tacked on this relief bill to it. And so just from a framework perspective, maybe just kind of understanding how those pieces work together. And so with that, we have you can unbuckle your seatbelt now. We have run through a long list of some pretty big things. And so, you originally, as this came out, we were kind of processing. It's like, oh, this is good. This is good. This is good. But like most of the relief, it feels like the more you dig into this, the better it feels. I mean, there are some really significant benefits. So Ben, if you don't mind advancing the slide for me. Um, Today, as we talked about our blueprint, we talked about our foundation. You can see as you go across the bottom, this is our old master blueprint. Obviously, we got some little changes in here that we'll update for the master blueprint. We probably won't go through the entire toolkit and update. We literally have a book that we've written out there. I was working through that over the course of the last little bit, and I think I might have had some PTSD that sunk in. There's been a lot of blood, sweat, and tears over the course of that book, or at least late hours. I'll just say that. Probably no blood, sweat, or tears, but late hours for sure. And but all of this blue sort of piece across the bottom in our capitalized to viability or deploy to margin. You see today we talked about EIDL, we talked about the triple P, we talked about what was a consolation prize with the employee retention credit. Payroll tax deferral, didn't spend any time on that. The employee retention credit, though, now the ERC for the cool people like we talked about, it's not a consolation prize anymore. This is a really big deal. The expanded tax provisions, we talk about 100% for meals in this is an area. The benefit of the extension on the medical expense deduction. We didn't even get into a lot of the other things that we've spent a huge amount of time on the tax provisions about. But FFCRA, super excited about that, guys. The post and promote strategy. If you're eligible for this, you got a whole extra quarter. A lot of folks didn't take advantage of this over the course of the last 9 months. There's still opportunity to do that, particularly for those that end up due testing positive or dealing with a diagnosis or a seeking diagnosis or taking care of their family members. So take advantage of that. So Ben, if you don't mind, advance the slide. I just want to kind of close out with one little thought here around taking care of the house. It seems like over the course, of the pandemic, a lot of times we've found where folks have really leaned into their employees and tried to provide for them through this period on their own dime. And sometimes that's really hurt them. And so I think it's really important. We had the $600 a week benefit that rolled out that expired at the end of this year. Now it's $300 instead of $600. So it's not quite as material, but you've got to take care of the house. It's really important that you make decisions. We talked about, deploying the margin. Make sure you're making decisions that are taking, that are keeping the house healthy, that are taking care of the home. It's kind of putting on your own oxygen mask first. And so I do feel like we are in a new season. It feels very different than March, April, May, June of last year. We know where the virus is. We know where the economy is. Some of the election uncertainty has been moved away. Hey Ben, do you mind muting all for us real quick here? Thank you. And so as we move forward, and Ben, maybe advance the slide for me, we've got some different perspective. And so as we look to the future, we're in a really good spot. We got a great benefit here. Not only has the original relief bill helped lift up and encourage businesses and really help sustain them through this season, as we just talked about now, there's a little bit of something in here for everybody. And so particularly those that are hurting, that are in the most dire straits, and we do have some folks that have had amazing, just the best years ever, candidly, in 2020. And so, well, that's wonderful. They're going to be just fine. But for those that have struggled more, there is more help here and on the way. Triple P2, the shuttered venues. These are, and now the employee retention credit as a whole new world. I mean, that is a really nice benefit. And even the simplified loan application process is good. And so don't forget about posting and promoting. Make sure to take advantage of the FFCRA credits as we're taking care of the house like we talked about. And just from an overarching perspective, the reality of it is vaccines right now are being passed out. Folks have, a lot of people have had COVID and they've gotten to the other side of it. And, they've got some antibodies for a little while. And that is really good for the folks that have experienced that. They're not so much worried about it anymore. And the reality, though, is that, yes, there are still people hurting, and particularly outside of Middle Tennessee, as you go to some of the other larger cities and other areas of the country, and particularly those with more draconian lockdown measures, they are suffering. I mean, they are hurting. And so I think Middle Tennessee, it feels really good. And if we're inside of our little bubble here and, in a state that has great budget, and great leadership that has done a wonderful job from an economic standpoint, it feels a lot different than some of these other states across the nation. But overall, a lot of money has been pumped into the economy. And I think that we are in a place we can see the future and we see the way out. We see the path out. And so I am really excited for what 2021 is going to bring for our client base, what 2021 is going to bring for our state, and particularly some of our nonprofits. Hopefully we are able to start getting back to not a new normal, but a normal operational model. And so we are excited to see that. It is time to press on, as we say. And so I'm just really excited for what 2021 is going to bring for our clients and for our community and for our country and even our world. And so, in closing here, adjust your taxable income. We're not deducting the expenses. It's time to deduct them now. Are you eligible for Triple P2? If you've experienced that revenue decline 25%, get in line, get ready to go after that. Double check whether you need to be 2.5 times or 3.5 times if you meet the hospitality or restaurant definition. The employee retention credit, this is just amazing. I mean, hindsight's 2020. Obviously now we can go back and do that. And foresight, well, we need to integrate that on a going forward basis to make sure that Triple P2 dollars, which most likely you'll be eligible for if you are going to get the retention credit, are integrated in with those forgiveness amounts. And so really, really important. What matters most matters more, all that much more important. Build that foundation, make these great decisions for your business. What we talk about, what is it that matters most? It's making good decisions when it comes to cost accounting, understanding where you're making revenue, understanding where you're making margin. Spend time on those things that are most profitable to the business. Well, how do you know what that is? You got to study your numbers. You got to do the right accounting. You got to have the right processes built in place to be able to take advantage of those things that are creating the greatest value for the company as well as for your team members as well. So get back to those basics. And I think that's the key here as we move into 2021. Take advantage of these closing provisions that are out here that are really significant. But in addition to that, get back to those basics. Get back to the things that made you successful. And then from this experience, we have all learned new things. This has helped us advance at a faster rate than we probably would have advanced technologically in so many industries, and adapt. Things will be different. At the same time, integrate those things that have made you successful in the past with these new skills, these new things that have transpired, and adjust those plans and be strategic as you move forward into the future. So I just want to say thank you to everyone. Thank you to our wonderful clients, guys. This is our job. We are in the client service business. We talk about our goals. You can see them up there in our culture and value statement. Stewardship. It is so important for us to take wonderful care of you. And so thank you so much for the opportunity to serve you. We want to be expert guides. We want to look at things through your eyes and have your vision and help adjust that vision, help you see where you need to go. Like hopefully we've done today to say, hey, I need to integrate Triple P2, employee retention credit. Help bring that information and provide that guidance. And then hopefully what our goal is at the center of our target, at the bullseye, as Michelle Balsley would say in our firm, is real relationships. That's what we're about here at the firm. Thank you for allowing us to have real relationships with you. Thanks for joining us today. May the Lord bless you and keep you, cause his face to shine upon you, give you peace and rest. And may 2021 be an amazing year. Take care, everybody.